Hello and welcome back to a special Easter edition of Real Day Trading. It's actually not a special Easter edition of anything. It's just another edition of Real Day Trading, but here we are. So I have spent the last 2 to 3 months trying to crack the PDT problem. What started out as a 5K challenge, I did it before, I could do it again, right? Turned out to be a rabbit hole of trying to figure out how the hell can small balance accounts make money. First thing I ran into was the PDT restrictions. If you have a margin account, you can only do 3-day trades every 5 days. Well, this is a serious restriction because if you go through the old trader sync logs, you'll find that a vast majority of the trades were actually in profit during the day. If we could have day traded, we would have taken those profits. The idea of using a cash account has benefits, granted, it pains me to say, but you cannot use spreads. You only can pretty much use half your balance, and the danger of constantly falling into violations is high. Surely there must be a better way, and that way would be a better method. So the first thing that became clear was one must take only extremely high probability trades. Now let's just say on any given day, there's around 20 to 30 good setups out there. You can find them: relative strength, relative weakness, going with the market, a couple of stocks, maybe some momentum stocks that have a news catalyst. There's around 20 to 30. Out of those 20 to 30 trades, there's probably on average 1 to 3 that are excellent. They check all of the boxes. They're extremely high probability trades, generally meaning something would have to go very wrong for those trades not to work out. Okay, we would need to focus only on those trades. What are those trades and how do you find them? Well, after going through various types of setups and using relative strength and relative weakness, the problem is that when you have a volatile market that you can't swing, and just take a quick look here at SPY, this is the definition of a volatile market. SPY really has gone nowhere since January 21st, since almost the beginning of the year. It's still right where it is. But look at the journey it has taken. Very difficult to swing this. Even here, this would have been a good swing trading environment, but very difficult to trust this swing trading environment, and for good reason. Look what happens. So we need to find these trades. We need to find something that was stronger than traditional areas of technical support and resistance. Your SMAs, your basic trend lines, you know the deal. So in comes algo lines. These are a specific type of trend line. You will not find them anywhere if you try to search them online. These are high volume candles, not earning candles, that are connected in a very particular way that create areas of support and resistance. These areas of support and resistance are programmed into the institutional algorithms for buying and selling. Pretty straightforward. However, going even more in depth on it, I found a way to identify algo price points. These are intersecting algo lines that give you a particular price point. Now, there are different type of price points that could be formed, and all of that was gone over in various posts. Then it comes down to, well, what trade strategy are you going to use? You can buy stock, you can use spreads, you can do straight calls and puts, you could sell puts, you could sell calls. But wait a minute, you can't. Because what turns out is the biggest restriction on a low balance account is the low balance. In my other account, I can sell puts on Tesla if I want. I can buy straight calls on Amazon. I can buy Home Depot stock all day long. And then I can sell calls against it. I can do none of that in a low balance account. So what happens? People with accounts that have around $5,000 in it pretty much do what I tried to do, which is you go for the options that are expiring that same week. Why? They're much cheaper, right? Would you rather get one call on Oxy that is a week out or three calls on Oxy that expire in 2 days? Well, Oxy looks really good, so I'm going to go with the three calls. Nope. That doesn't work because the enemy here is time. These trades, again, going back through the journal, and if I do the walkaway analysis on them, not only are a vast majority of them profitable during that day, could not take profit, but a vast majority of them came back around again to profit given another week. But we didn't have another week, did we? No, we did not. Why? Because the options were all bought for that week. Which also means that doing spreads, which expire that same week, and buying back the short side of the spread, which we've done quite frequently, turned out not to be a good strategy. So after I narrowed down all of the strategies that didn't work, pared away everything, it turns out buying straight calls and puts that are in the money at least 1 week out from expiration is the best method to use. Finding the top 1 percentile, 5 percentile type trades, and then buying in the money calls or puts, depending on the direction, at least a week out on those tickers. So that's where we are. That's what we're going to do. So we reset here, and these are the three positions we're starting with. Already made a mistake, by the way. So, first one we're going to take a look at is NOV. NOV is a classic high probability trade. Well, look what. We're going to go to NOV here. Here's NOV. Now remember, the white candles, no parking in the white zone. The white candles are above average volume and it went up for the day. So this would have been a green candle. And the yellow are above average volume, but they went down for the day. And everything else is a regular candle. So here we are on NOV, and we have an upward sloping algo line here, connects there, extrapolated out to here. We have a downward sloping one, offers resistance, doesn't quite touch here, but here, and then it breaches it to the upside here. We also, well, I didn't really do that, did I? I was doing on the wrong one. Here, and here. See, I went backwards. Here is your price point, right? Right there. And that price point's around 1980. Well, today we breached that price point, okay, several times here, danced around it, and then today we breached it. You can see the price hovering on that price point, but it doesn't become an algo price point until today where it comes through here. And there we are breaching it to the upside. You can also see NOV today showing really good relative strength to SPY. Here is SPY right here dropping. Look at that huge drop. NOV staying strong. Another huge drop here. NOV going up. And here we are in after hours. And NOV has actually continued to go up. And it's up around, I don't know, ended at here, almost 60 cents here. So we grabbed 2 calls at the 20 strike for $1.01 each. They broke the algo price point resistance. They broke algo resistance. Good relative volume. I am ranking these trades, by the way, going forward, 1 through 5. 1 being it's good. It's if you could day trade it, you would definitely take this trade, but it's sort of the lowest of the top tier. 5 being like this is a great trade. You can almost bank on it unless some dire event happens. I rank NOV of 4 as relative strength to its sector. We took straight calls, and there was also an upside break of compression on it. So over here we could see, obviously, this is almost a month long of compression, and it broke it to the upside here. So here was our first trade using the new strategy. Ticks off all the boxes. It's straight calls. It's a week out. Next, what is our next trade? Our next trade that we did, well, this was actually the first one we did, but the next one we did was Nike. Now there's a slight little problem with Nike, and we'll go over that. But we grabbed the 132 strike calls. Those are fairly about 0.7 delta in the money. And we took 2 of them for $3.30 each. So we spent $660 on these. And the way this is going to work, by the way, is we're just going to keep adding these trades here until we make $20,000 using the strategy. That's it. We're starting, I don't know, around 1,500, somewhere around there. And we're just going to keep using this strategy until we get up to $20,000 in profit. If the strategy works, it'll be a grind, but the more we make money, the bigger the positions can be, the faster we will make money. And this is going to be a step-by-step growing of the account. So back to Nike and the problem with it. We're going to go to Nike here and go here on Nike. Now, this is a different type of price point. Right here is the price point, and it comes in around 128.50, right? And we have an upward sloping line here, which was violated to the downside on a gap down. We'll make it red because it violated to the downside. And then here we have a downward sloping algo line here. And you can see it's actually offering some pretty strong support and has not yet been breached. These two cross each other, creating this price point. Let's take a look at what Nike did. We will get rid of the after hours. Okay, here's Nike today. Amazing relative strength in the stock, right? It starts out and just screams up. off of really good analyst news. The market is like getting smacked down. Nike don't care. Nike keeps going. Now it settles in right around here. Why does it settle in right around there? Well, we can see that here is the 50-day moving average right there. The question remains, is it having trouble getting through the 50-day moving average because of the 50-day moving average, or because it just needed a little bit of a market push? I am leaning towards the latter. Every time it got a bump here in the market, it went through that moving average. Even down here, a little bit of a bump goes through it here. A little bump here goes through it. Every single time the market gave it any help at all, it went through it like it wasn't even there. And in fact, if you took away that SMA, you wouldn't even know it's there. You would just think, all right, Nike has jumped up, and then now the market is starting to collapse, and so it is just consolidating here. And that's what it's doing. The problem is that it is there, and there is a chance that the 50-day moving average will offer some resistance. But given the strength of this stock, and given how much volume we saw in it today, and the weakness in the market, and the weakness in this stock's own sector, any type of market push next week, I believe, is going to send Nike not only over its SMA, but once it gets past there, there is a lot of open air up here for Nike to run. All the way up to like 152. So that is our second position. 2 calls, straight calls. So now we have 2 bullish positions in a rather bearish market, right? However, let's take another look at SPY and look here at the support that is formed on SPY. Plus, we're going into earnings season next week. Almost without fail, the market sees a lift going into earnings season. So I wanted to take strong stocks that are performing well in the bearish cycle today, going into next week's earning push. On top of that, we're looking at this support here. Plus, put on the SMAs. We're hovering right around the 50. We should pop back up to it. So that was the theory, but here is the mistake I made. I grabbed, without thinking, going at the old mentality, BABA. Now, what's wrong with that? BABA actually was a good trade. It was a good trade. Thank you. Well, here's the problem with BABA. I had said and wrote in the on the post, on the big posting thing, the place where you do the posting, and I do my posting there. I posted that we were no longer going to do balancing. Balancing bad. Balancing does not work with these small accounts. It just winds up being a slow drain. Why? Once again, you have to be able to act nimbly. If all of a sudden, is nimbly a word? It sounds like it shouldn't be a word. I guess it is. If you are short a couple of positions and long a couple of positions, and then all of a sudden your shorts are in profit, well, you need to be able to take profit on one side and then let the market switch over and take it on the other side. Back and forth you go. You need flexibility for that. And these accounts do not have flexibility. That's why it's bad. But what did I do? I put on a short when I had bullish positions. So I took the put on BABA here, one of them, for $5.40. That's $540. That's a big chunk of the account. And I took the 100 strike puts. You see them right there, right? The problem is that one against everything else. Now you can see BABA broke down below its upward sloping algo line. It broke below its algo price point. BABA is pretty damn bearish. And this is a really bearish M5 today. BABA was a good trade. And in fact, the put itself is in profit. But because I did not want to balance, I decided to pretty much mitigate this, even though it will still, oh, there's Trade Exchange, by the way. Damn thing pays for itself. This is the best, if you don't have this, this is the best news streaming service I've found. It's really good. Back here. So I sold, even though I said we're not doing any more spreads, I sold the 95 against it for $2.62. Now, if we wind up, if BABA winds up finishing under 95, right, we'll keep obviously that 262 and also keep the, what do you got, $2.38 for the difference on the long call. So it'll come to the close to the $5 in profit. We could still make a good amount of profit on this trade. But I did not want to have a straight put on. I wanted to commit the portfolio to a direction. So I was rectifying the mistake by kind of capping this put and selling the 95s, right? If on Monday we open higher, which I believe we will, then I will buy back that 95 and I'll probably just close the entire trade, right? But our losses will be mitigated there. Even though right now we're actually up around $90 on it. So, okay. If BABA wasn't there, we'd have those two trades. So that is what we're doing going forward. And a couple of points to people. I have, and so when you see posting trades, and I also put a post about this. There's several different accounts that I use. I use one account for long-term investing. That's where all the stocks are. And I'll sell calls against them, depending on how much premium you can get. Sometimes it's not worth it. But I'll sell calls against those positions. And all of those positions generally come from selling puts. I do not sell a put on something unless I want to own the stock, right? And, I have, for example, MU, Microsoft, I have AMD. All these come from selling puts. If I get assigned, I'm glad I got assigned because I wanted to have the stock. At that point, if the stock is down, I can do dollar cost averaging. I can average down because I have the stock long term. Those rules do not apply to swing trading and day trading, though. You don't want to do DCA or averaging down when you're swing trading, even though sometimes there are exceptions and one does. So just to give some clarity there on some of the types of trades. Today there was a number of really good trades, very profitable trades that were made. For example, took a few dollars off of Caterpillar. Caterpillar, one of those really strong stocks today. It had, let's see here, there we are. Caterpillar, this is the market going down. Caterpillar just kept going up, right? And I think I bought in right around here, right around there, and sold right up around here. Could have gotten maybe an extra 50 cents out of it, but Caterpillar was fine. I have INDO. That stock is insane. It just, yeah. I did a really great lotto on NVIDIA here. You can see NVIDIA bought the lotto right towards the end for 32 cents, and I took a double on that one. Sold it for 64 cents. And that one there, because NVIDIA broke below algo support. Not a cross section, not an intersection, it's straight up. Here's the line, here's the touch, right there, broke through. And when it did, it just dropped down, popped back up a little bit, but that was a really good sign. If you can catch it right as it breaks through, you're going to get some sell stops in there, and you might catch a nice drop, or you're going to get a nice pop. Drop or pop. Fun. Okay, so that's where we are. We're going to now repopulate and update that journal with those straight calls and puts. There'll be very few exceptions to those. Might do a lotto play every now and then. Might do not really gonna do any spec plays. A couple worked out for us, but the spec plays also don't seem to work very well in these accounts. You don't have enough maneuverability or money to add to it to average down, which you tend to have to do on spec plays a lot. So we're not going to do those either. And we'll see. We'll see how it goes with each individual trade. And our goal is to make $20,000 using this strategy. It is now April 14th. We will see how long it takes. Probably a good chance it'll be 2025, and I'll be like, all right, I found another strategy. Here it is. You gotta take the double, triple trend line and mix it with the algo dip in the focal point of the volume profile. And when you do that, then you get a corridor, and you take the average of the low and the high of the corridor, and there it is. There it is. There it is. Did I go too far with that one? Maybe, but that's probably not far from the damn truth. Oh my God. All right. If I don't do another video, have a good weekend, everyone, and I will talk to you on Monday. Oh my God, I can't believe it. It's been so long. I cannot believe this. Yes, of course. How could I forget? Because if you're not just driving yourself crazy over this small account issue, read the damn wiki. And particularly if you can day trade. If you are a day trader, it is beyond essential that you read the damn wiki. So read it. And now you can all have a good weekend. Goodbye.